Hello, everyone, and welcome to another episode of Meet the Investor. Joining me today is Regina Liu, APAC Head of Investment Specialists for International Equity at JP Morgan Asset Management. JP Morgan Asset Management currently manages over $1 trillion in equities across the world. And Regina, representing the team, will be speaking to us today about their Global Research Enhanced Index strategy. Thank you for joining us today, Regina.
Great. Hi, Joey.
Regina, maybe we could start as we often do on these with you telling me a little bit about your background, about the background of JP Morgan's equities team, and specifically with respect to the Research Enhanced Index strategy that we're focusing on today.
Sure, very happy to. Thank you very much, Joey, for having me today. Just a little bit of background of myself. So I'm based out of Hong Kong as an investment specialist for our international and global equities for JP Morgan Asset Management. This is my 17th year with JP Morgan Asset Management. I started in high school for sure, Joey, and but more about JP Morgan. Our JP Morgan Global Equities team manages over $1 trillion of assets globally, and obviously it's a very robust engine. I would call it one of the probably most resourceful platforms in the world, and specifically to the Global Research Enhanced Index strategy, which we're going to spend a little bit more time on. I do think that it is a very unique strategy that leverages the broader platform's insights in delivering the best outcome for our investors. So very happy to spend a little bit more time there as our conversation continues.
Well, great. Thank you, Regina. And let's get right into the strategy. How would you compare for investors that are used to active fund managers and maybe passive tracking exchange traded funds or ETFs? How would you compare this strategy to those type of investments in the equities world?
Yeah, so that's a very interesting question for our Global Research Enhanced Index strategy, right? So I'd probably call it Global REI, so we're not a little bit of a mouthful of the full name of the strategy. But as the name suggested, it is a strategy where we use the fundamental research process to enhance the index. Right. So what we're really trying to do, if you think about the genesis of the strategy, a couple decades ago, is that we intend to build a strategy back in the 90s to compete with our passive peers. Right. So if you think about, passive investing, it is about replicating the benchmark index of the allocation that you wanted to have, right? So if you wanted a global equity exposure, what you try to do is you try to replicate that benchmark out there. You try to replicate that MSCI World benchmark and try to deliver the same performance as the benchmark. Now, what's going to happen is that if you're constantly trying to be investing passively, you will find yourself consistently slightly underperforming the benchmark by the amount of fees that you pay. Now, although you do pay very little fees, but at the end of the day, because you're only trying to deliver what the index is delivering, you will slightly underperform it over the long run. We thought about it and said, look, JP Morgan Asset Management has a very big equity platform. We have a very robust engine, as I mentioned. So why don't we try to build a strategy that work our clients' monies a little bit harder by leveraging our fundamental research work? So here comes the Global Research Enhanced Index strategy. What we try to do is we build a portfolio that resembles the index very closely, so we don't take any specific active bets from a macro standpoint, right? So from a sector allocation or geographical allocation, it looks exactly like the benchmark. But here we try to take the input from our research team. We will be slightly overweighting on companies which our research team identify as attractive opportunities, and slightly underweight the companies we deem to be a little bit less attractive. So we just thought over time, it's just a process of us trying to offer a very pure exposure to the global equity market, but being able to ride on the additional research work that we do have on the platform.
With such a robust research process, why the emphasis on minimizing, I guess you'd refer to it as tracking error or how far you deviate from the benchmark? Why wouldn't you just back the analysts and aggressively invest in the companies that they select?
Yeah, that's a very fair question, Joey. And I guess what I would say is that on the overall JP Morgan platform, we do have strategies that is more active, that tends to take more risk in the portfolio. But when we build out this global research enhanced index strategy, our focus is to try to minimize, a lot of that risk versus the benchmark, right? So when you set tracking error, essentially is the measurement of how closely the portfolio actually follows its benchmark index. We try to minimize that tracking error because we think that's a better way in terms of managing the risk. Investors who is investing in this particular portfolio know exactly the risk that they're taking, which is essentially the benchmark. But all we're trying to do is to add a little bit of that fundamental research insight so that over time it would provide a little bit more of a smoother equity ride for investors. You won't expect this strategy to be giving you outsized outperformance, but neither would this strategy come down to a very big drawdown versus the benchmark. So not to say that, we're not taking risk, but I think over time for investors who are really just wanting to have that global equity exposure could actually find this to be a very useful strategy versus their passive allocation, just because it allows us to have a little bit of a smoother ride over time.
And so a lot of that matching the benchmark and ensuring that you are neutral against different sectors, different geographies, and so on, that would require a fair amount of quantitative power. What tools do you have to make sure that you're on an ongoing basis not deviating too far away from the benchmarks while enabling yourself to invest in the top picks of your team?
Yeah, so obviously it is very important for us to making sure that, we have a very consistent way in terms of minimizing that tracking error. So point number one is that our portfolio managers does have a pretty stringent guidelines that constrain the portfolio versus the benchmark, right? So for any sector allocations or geographical allocation, there is a hard guideline that we cannot be taking a deviation more than plus or minus 2% versus the benchmark. And the same thing for individual stocks, right? So every single position that we take, we cannot have more than a 0.5% plus or minus overweight or underweight position for the benchmark. So at the end of the day, we're building a portfolio that is within very tight constraints. And so on the outset, we are ensuring that our tracking error is quite minimized, that we are delivering the shape of the index to the investors, as the product construct. Now, that being said, I would definitely highlight the fact that over time, JP Morgan Asset Management continues to invest from a technological standpoint. So about 10 years ago, JP Morgan has built our own proprietary portfolio construction tool called Spectrum. And it is a tool that our portfolio managers now uses on our platform day in, day out. They have the ability to, review the portfolio at real time. So they do actually have a very, very rigid view on everything that's happening on the portfolio at any given point in time, making sure that we're not deviating versus the benchmark and we're delivering what we said we're going to deliver within the portfolio for our clients.
And you've mentioned and touched on your research analysts a few times. Clearly, JP Morgan has a terrific pedigree in global equities, managing over $1 trillion there. Can you tell us a little bit about the size of the team and the number of analysts to cover what I imagine is a very large coverage base of stocks to pick from?
For sure. And, we definitely recognize that as a global equity investor, it's not the work for a couple individuals that could actually, uncover all the opportunities around the world. So we do have a team of 80 research analysts covering 2,500 companies globally. Our research analyst is located around 9 different locations globally. And we do actually feel very, we're very blessed in the sense that we have been able to identify on the ground, very experienced research analysts. And we've also recently done a tally. Our research analyst team altogether speaks 37 different languages. which is something that we do actually feel like is very important because you do need that on the ground experience so that the research analyst can really understand what's happening to those company, and those become something that's very, very invaluable to us when we're trying to find that little extra step in understanding the details of an individual company.
And when those multilingual, deep research team of analysts are doing the analysis on their companies, what are the main areas that they look at when selecting or identifying what a good company is?
Yeah, there are four main areas that we focus on when our research analysts are looking at or determining the quality of the company under coverage. Oftentimes, we think of companies first starting off with the economics, in the sense that we're trying to understand whether this company could actually create value for shareholders. So here we'll start looking at the balance sheet strength, the cash flow generation ability of the company, etc. Then the next question that we try to answer is, if this company actually creates value for investors, does it actually create value in a sustainable way? So the duration of things, like for how long term we could expect this company continue to be delivering for the investors. So here you start to consider the competitive advantage of the company. You start to think about, the industry trend, whether or not there are barriers of entry, are there new competition, etc. And the third thing that we consider is, if this company does create value on sustainably, then whether us as minority shareholders does get the benefit of the company, then it comes the governance. You start looking at the capital allocation, the management competencies, and you're also looking at the shareholder policies, etc., to understand the governance of the company. We also take into the ESG aspects of the company a lot of the times. Each of our research analysts does actually have a very standard 40-question questionnaire that they need to fill out. All the 40 questions are related to ESG. All the questions are also intentionally built to be binary, so they're all yes/no answers. So we wanted our research analysts to be making that judgment call of that particular ESG aspect for the company. Otherwise, we felt that oftentimes we see our research analysts going yes, but, or no, but, and that becomes quite difficult to sort of figure out what the real problem is for a particular company. When you think about selecting companies, I think a lot of times it's also about having a differentiated insights, which is something that's very important. Because if our research analyst has only been able to identify what everybody can identify in the street, it doesn't actually give us that additional edge. So one of the examples that I would give is back in back in 2015, 2016, this is the company, this is Texas Instrument in the US, right? So it's a semiconductor company. But at the time you think of Texas Instrument, it is a company that is doing a lot of the very traditional chip making, right? So it's mostly on VCRs at the time, TV screens, LED screens, etc. Our research analysts actually identified that chip making technology that Texas Instrument is engaging in could potentially be used in electric vehicle. If you think about it, 10 years ago, electric vehicle is probably something that is still in our imagination, is still not something that has really come to the market at the time. And at the time, Texas Instrument actually dismissed our research analyst comments and say, well, no, we are focused on doing what we have been good at, and we're not engaging in electric vehicle. But nonetheless, our research analysts have a very strong view that that technology really suits that new upcoming structural trend. So we've leaned into the opportunity. Fast forward, I think that was about 2 years ago, the CEO of Texas Instruments comes to us and said, well, he was wrong and we were right. Today, Texas Instrument has about 30 to 40% of their revenue is actually generated from EV chips. So you do see that the importance of having the research analysts really understanding the technology, understanding the scientific foundation of these type of companies, and being able to make a call at the time when no one else is making that call is something that's extremely valuable.
Well, that brings me very nicely into my next question. I was going to ask more generically, with investing, how do you know how long you have to wait to be proven right? And if you are proven right, when do you know when it's time to take profits, I guess, or to invest into something else? Maybe you could answer that generally, but also with respect to, say, the Texas Instruments example that you just gave us. That's a long time to believe that you, the analyst, is correct in the face of management themselves, not even thinking that that's part of the thesis for where the stock performance may come from. How long do you wait for that to play out, and generally, how do you time these things in such a way?
That's a fair point, Joey, because I guess oftentimes, you can get quite frustrated, especially amidst that market volatility and when things don't really work out. But to be fair, when it comes to investment, we do actually ask our research analysts to try to ignore the shorter term catalysts and the shorter term news flows and have them focus on what we call a normalized earnings cycle. So we do actually want our research analysts to actually look out at least 3 years from now when they're thinking about the earnings ability of the company. And for that matter, we actually ask our research analysts to even look out further into year 5, year 6, considering the growth potential of the company. So generally, within our research framework, each company under coverage loosely has actually a year 6 price target. Now, you could say that that means that your investment thesis kind of had to wait 6 years to fulfill. But that being said, what we then try to do is that we try to discount that year 6 price target back to today's stock price. So there, that will give you an implied expected return of each of the company under coverage. Because now what's very important is that if this is a great company to invest into, the big next question is, at what price do you want to own this company at, right? So a lot of the times what we're really trying to do is we try to look for companies that is going to do well and sustainably well for the next 5 to 6 years. But the company should be trading today at a very reasonable valuation. And that combination is what we're looking out for. So oftentimes what happens is that, if we have a investment idea that looks very reasonably interesting for the next 5 to 6 years, but the stock price today has already been pricing in a lot of that growth potential for whatever reason, that does not come out to be an interesting investment idea for us. Oftentimes, we need to be looking out for opportunities when the current valuation could be seeing a little bit of that cyclical headwind. Those are the opportunities where we feel like we could lean into companies knowing the fact that in the next 5 to 6 years, this company is going to stay very, very intact. So those are some of the metrics that we use when we think about that valuation, how to think about when to get in and out of a particular name, despite the fact that it could be a great company, but it doesn't necessarily mean that it's a great investment at a particular time period.
So a fair amount of human overlay to all of that. Um, Having said that, there's a lot of number crunching as well, both on discounted prices and right valuations, and even the performance of the company itself, its balance sheet, its income statement. With the amount of technology in this space, systematic analysis of these financial statements, and obviously AI being a buzzword, I'm sure that there will be more and more artificial intelligence being used in this type of analysis. How does this type of process with human research analysts behind the scenes stay ahead and ensure that it doesn't get computerized out?
Yeah, I think there's always a quote that said, AI won't replace you, but people who knows AI might. So I think this is sort of where we are at, right? So we do actually feel like AI or data analytics or the use of Python, for example. We actually have multiple of our more junior portfolio managers who are very, very eloquent Python coders, for example. We do actually see that being able to make use of that data points can actually make our work more efficient and more productive. JP Morgan has been, has been embracing technology, if you would, from years ago. Well, we started off, using natural language processing tool back in the days, which is much more sophisticated today. If you think 10 years ago, you remember the natural language processing tool basically would count the number of positive words that you use. And in the sense that they would not be able to identify good morning or this is a good question, for example, in the transcript back then. Now they have the ability to actually read through everything to really give you the summary. it has actually significantly, for example, cut down on the number of man-hours that our research analysts need to spend on companies' calls, for example. We now actually use the AI tool to summarize a lot of those calls, and they would highlight which are some of the calls that our research analysts should be spending time on, instead of having each of our research analysts just dialing into companies' call on a quarterly basis to just listen out on something that might turn out to be just BAU. We are also seeing we're using more of that technology to actually verify some of the data points from our research analysts. Research analysts are human beings, which means that a lot of times, there could be individuals who are more optimistic or individuals who tend to be a little bit more pessimistic. And in the past, it's very difficult to level set those research work from individuals who fundamentally, some of them being a little bit more aggressive, some of them being a little more conservative. Today, we actually we can use big data points to say that objectively, if you look at all these macro data points, we would come to the conclusion that the research signals coming through from this research analyst seems to be perpetually a little bit more optimistic. So then we can have the conversation with our research analysts and say, hey, it looks like you are running ahead of ourselves a little bit commonly. So let's bring ourselves back and have that conversation and see where we can make ourselves a bit more productive. So we do actually feel that technology has been a very, very useful tool in helping our research analysts to become more efficient. But that being said, if I go back to that Texas Instrument example, you would see that, still having that real person view, that differentiated insight to make a call, a judgment call to say that, this is what I think is how things are going to change in the future is probably still something that AI and technology is not being able to do yet. And we still find it invaluable to have people who have been spending time with the corporate management and being able to make those calls. And those things are things that cannot be computed away as yet.
JP Morgan naturally has a huge amount of global reach and exposure to lots of different clients. What trends have you observed with respect to how institutional clients all the way down to wealth and retail clients have been investing, how they've been investing in the stock market? What trends have you observed in patterns over the last few years, and are they starting to change their approach there as well?
Yeah, I think JP Morgan is a active management asset manager, as Joey, you would know. And obviously for the last sort of 10, 15 years, if you look at a lot of the academic works, they're probably going to be pointing to the fact that passive investing to some extent has dominated the equity landscape for quite a good part of the last decade. I would argue that, on low interest rates, when fiscal stimulus is still quite abundant in the market, those are things that have driven a lot of that market. And I think I do actually also feel like, in over the course of the last 10, 15 years, when the market was perpetually on very low interest rates, that has also given way to a lot of the growthier part of the market, just because capital is cheaper, right? When on low interest rates, your capital is cheap, so you are willing to spend time to wait on a investment opportunity to materialize. You have the patience. As the interest rate market normalizes, so I'm not to say that it's very high interest rates today, but at least your capital is a little bit more expensive. There is an opportunity cost when it comes to making investment. So you're starting to see that, that fundamental research that we have been standing by, looking out for long-term good quality companies and compensating for the fact that we're not overpaying for those companies. That combination is something that we feel like large institutional investors are starting to recognize the merits of the fact that these fundamental philosophies should be coming back. So I felt like, as we move forward, we could actually see more investors embracing strategies like the Global Research Enhanced Index, where you would want to take a little bit of that have a little bit of that activeness, if you will, in your portfolio, rather than just staying pure passive, which we have seen has worked quite well for investors over the course of the last 10, 15 years. But moving forward, I think things could change a little bit. And I think a lot of the large institutional investors, as well as some of the wealth investors, are starting to recognize that and starting to see the merits of active coming back.
And so you've touched on there this structurally higher interest rate environment might benefit more fundamental active stock picking. The other big trend in the market and the outlook at the moment is the volatility and uncertainty with respect to the US administration and trade wars and so on. How do you see that affecting strategies like this, and how do you price that level of uncertainty into making forecasts on how companies may or may not do over the near to medium term?
Well, yes, volatility is expected to remain high, which is obviously one of the more challenging periods for equity investors, particularly as you see a lot of that short-term news flows coming through and you see those short-term rotations happening. But as long-term investors, we're actually pretty excited about these kind of moments. If you think about our fundamental research, which we have spent some time on, we're constantly trying to look for good quality companies trading at reasonable valuations. But these are the market environments where investors are a little bit irrational. They are driven by either extreme optimism or extreme pessimism, which means that a lot of the times we are seeing some price dislocation for some of these companies. So take tariff as an example, right? Most of us would think that tariff is negative for equity investors, but when we do have our research analysts really look into the details of the company under coverage, we do actually see that some companies could potentially be a beneficiary of the current market situation. So for example, in the heavy truck space in the US, right, the heavy truck space is pretty much an oligopoly market. There's very few players in that market. One of the major players there is Volvo. Volvo is a company that, for the last few years have been localizing a lot of their U.S. manufacturing into the U.S. since Trump 1.0. So a lot of the U.S. book orders are manufactured in the U.S., which means that Volvo is not really impacted by the tariffs. Now, some of their bigger, a few of the other bigger players in the market, for example, Daimler, they import about 70% of their goods and materials from Mexico. So which does mean that Daimler is clearly going to be more impacted by tariffs. Now, because it's an oligopoly market, the heavy truck consumers are actually expecting the prices for the heavy trucks to go up because Daimler, for example, will have to raise their prices to maintain their market share. But on the flip side, Volvo can also increase their prices for their heavy trucks, but on the basis that they are actually not very impacted by tariffs. Now, in the short term, both companies are sold off on the back of the fact that overall book orders are coming down just because heavy truck consumers are saying, well, in this particular market environment, let's buy fewer of these heavy trucks. But if you look out that 3, 4, 5, 6 years that we are looking out for, as long as the logistics demand in the US is not slowing down, the order books will have to normalize. And in that market environment, Volvo is going to be positioned in a very good position to outpace their competitors in the market. So you could see how in different market environments, you can get pretty excited because right now we can actually invest in Volvo at very, very reasonable valuations just because of that price dislocation, as the market in general doesn't really have the insight to know the differences between the companies that is operating in the very similar market. So I guess in this market, I would say it could be a little bit frustrating when you see that volatility coming through. You could see yourself being stuck into, having to be a little bit more patient for those investment theses to come through. But that being said, if you stay as a reasonably long-term horizon, this is actually pretty exciting moments for us in terms of being able to find those investment opportunities in this market times.
Well, as they say, volatility creates opportunity. Finally, as we wrap up now after this last question, is there anything we haven't discussed that you'd like to leave us with respect to the strategy, portfolio construction, or the market that we haven't covered already?
We have touched on a lot, Joey, but I think the only thing that I would probably try to make a case for equity. I mean, I feel like, we are seeing investors sort of shying away from taking that equity risk at the moment. But what I would say is that if you think beginning of 2025, like before a lot of those geopolitical policies coming through, we were actually pretty reasonably comfortable with the corporate earnings for 2025. The financial system, the economy was reasonably healthy. So what I would say is that, this is not the times in 2008 where the financial system is overheating, there's a liquidity issue that things need to fix. We are actually seeing an external shock, if you will, coming through, from that geopolitical conversations, which means that once that external force is lifted, you could see the market actually normalize very, very quickly. So I would just say that, I would still try to argue for the fact that, as we see, as we focus on the individual corporate earnings, which is still looking pretty reasonable, I would still make the case for equity still looking reasonable, attractive, especially when valuation actually looks less stretched than it was, about 6 months ago.
Regina, that's a great note to finish on. Thank you so much for your time today. It's been great speaking to you.